I'm going to teach you how to trade options in under 5 minutes. Let's go. Now to start, if you don't know the difference between buying a call versus buying a put, when you buy a call, you're betting on the direction of that stock to go up, whereas when you're buying a put, you're betting on the direction of that stock to go down. So let's dive into a couple key terms. An option contract essentially gives you 100 times more leverage than buying a single share of a stock. But with this leverage comes more risk. Now, you've probably heard of option Greeks, and the only Greek that you need to know is called theta, which is time decay. The longer you hold an option contract, the more you have to pay to hold that contract, regardless of if that stock goes up or down. Now, what theta tells you is how much it'll cost to hold the option contract you have per day. And the closer that contract gets to what is called the expiration date, well, the more expensive that contract will get. And that brings me to the next term, which is, well, the expiration date. Now, with options, you actually choose a date at which point that contract expires. Now, a lot of beginners think that you're supposed to actually hold that option contract through expiration, but that's not the case. Now, the further away the expiration date, the safer those contracts will be, whereas the closer the expiration date, the riskier those contracts will be. Now, I typically like to buy contracts within a month to 2 months out. And that is essentially because theta, time decay, is much less behind those contracts. And ultimately, I will have more time for that move that I'm looking to see on that stock to play out. Now, on the other hand, if I was to buy a contract that expired 1 to 2 weeks out, well, those contracts are going to be more risky, and I will have less time for that actual move to play out that I'm looking to happen on that stock. So I may end up having to close that position just due to the fact that theta becomes increasingly more expensive because the expiration date is getting near. Options are essentially a ticking time bomb because most of the contracts are designed to expire worthless. This all will make a lot more sense when we take a look at what is called the options chain. Let's say that I want to buy some contracts that expire 2 months out, knowing that those are safer. I'm going to go to the June 21st contracts, and now you can see we're presented with a lot of information. On the top, we've got the Greeks. Again, you don't need to know the Greeks other than theta. Now, let's say I wanted to buy these contracts that expire June 21st. I'm going to be presented with the option to buy a specific strike price. So if I bought the 200 strike, I'm in essence saying I think Apple is going to be trading at or above $200 per share at that time. And when we see the price here, for example, the 180 strike is displayed as $8.75. That contract does not cost $8.75. It costs $875. And that is due to the fact that options, like I said, give you that 100 to 1 leverage. We actually want to look at it in a different way by comparing both in the money and out of the money contracts. Now, in the money contracts on my platform are highlighted in blue, and out of the money contracts are in black. In this case, Apple is trading at 184. Anything below 184 when it comes to the strike is going to be in the money, highlighted in blue. They're going to cost more, but they're going to be safer. And anything in black is out of the money. Okay, so anything above the current share price, they're cheaper, they're riskier, you can make more money, but you can also lose more. With puts on the right, it's just reversed. So there's more value in contracts that are already trading in the money, and they're a lot safer. And so what I recommend is that you buy contracts that are in the money, at least buy a couple spaces. And when it comes to the expiration, like we said, buying contracts that expire within a couple of months out. Now that is going to limit your risk and limit the volatility behind those contracts. Let's say we're ready. We want to buy our contracts. We've identified these June 21st Apple contracts. We want to go a couple spaces in the money. We've got the $165 calls. We're going to click on buy, and we want to pay the least amount of money possible, which in this case, it looks like $21.10, which is $2,010 a contract, and we can go and send that order through. So now you should understand what options are and how to trade them. But in the first place, how are we going to go about deciding what stock do we trade and what direction do we bet on that stock going? Well, that's a great question. If you want to learn more, click the first link in the description below.